Now, why is this distinction important? Essentially, it's only the clearing banks which can add to the stock of money. Why? A clearing bank holds deposits in cash, which is a legal tender, from non-banks. It repays deposits in notes and makes payments for depositors by settlements in cash through an account with the central bank. So when a clearing bank extends its loan, it adds to its assets and simultaneously creates deposit liabilities against itself, increasing the broad money supply at the stroke of a pen. Now, this ability to create money out of thin air is limited essentially by the bank's capital in cash. Now, as cash can be borrowed from the central bank, the ultimate constraint on its ability to create money is its capital. But it's only because banks take in cash deposits, this is Keynes's famous widow's cruse, that they can create money. Many people have asked me, well, why is, but of course, S&Ls and the old, what do they call, mortgage institutions in the UK, they also take deposits, but it's very different. Why? When an S&L or a mortgage lender takes deposits or makes a mortgage loan, it has to clear these through deposits held at the clearing banks. So someone deposits cash at an S&L. This comes out of the depositor's bank account with a clearing bank. Similarly, when the SL makes a loan to a mortgagee, this comes from the SL's bank account with a clearing bank. Thus, the essential difference between non-bank financial institutions and clearing banks is that the former, these non-bank financial institutions, cannot create the bank deposit component of broad money, M2 or M4. Now, when the Federal Deposit Insurance Corporation, FDIC, was created in the US as part of the Roosevelt's New Deal, it was created largely to prevent bank runs, which the previous universal banks, very similar to what we have today in the West, because they had started gambling, which had really engendered their viability, and that led to bank runs. Now, the person who helped FDR to redesign the Federal Reserve System was someone called Mariner Eccles, who's forgotten. He later on served as the governor of the Fed I think he's the president of the Fed for a long, long time. He insisted, he's the person who said you must have deposit insurance, but he insisted that with deposit insurance, the banking industry must be split in half. The public utility part of the financial system, which provides the payment system, must be kept separate from the gambling investment banking part. Now, it's recognized that the gambling part is an essential part of a dynamic economy because it's these very gambles which impart dynamic efficiency through the process, well-known Schumpeterian process of creative destruction. Okay, but if these gamblers are protected against losses by taxpayers through being able to use the payment system to gamble, and because the clearing system that has deposit insurance, the deposit is insured, then the gamblers will always win. They'll keep their gains when their gambles are proved correct, and they'll pass their losses on to taxpayers when gambles turn sour. And hence the Glass-Steagall Act. Now, that did constrain the size of the banking industry. It meant that you couldn't get these phenomenal profits which the universal banks earned. But very often, and of course, in those days, this was at the expense of their depositors. The depositors went to the wall and they did bank runs. But today, in the current universal system, we see all around us, when the gambles go sour, implicitly or explicitly, once you've got this, the gamble with the deposit base, governments are forced, in fact, to bail them out. Okay. Now, this is the major cause of the current crisis, why it differed from what happened in the 1970s. That this time around, these imprudent lenders were actually really threatening the deposit-taking institutions and hence the payment system, the utility-based payment system of the global financial, well, mainly the US, but ipso facto, it also threatened this whole structure of globalized finance. Now, this emergence of universal banking, which in the US goes back to the mid-90s with the abolition of Glass-Steagall, this was followed by a number of other policy mistakes on the path to the first current crisis. I'll just list them. Now, it began with the bailout of LTCM, if you've forgotten LTCM, long-term capital management, in 1998. These are characters, Masters Universe. In fact, one of them, very famous, he won the Nobel Prize. Scholars, he was actually at Tokyo at the Mont meeting, and I asked him, and he said, oh, people like you obviously don't think too highly of me because we're bailed out. And I said, you bet. Now, there's no reason to bail them out. They took a gamble on Russian bonds, and they came across this famed black swan. You know, these characters that got these distributions, and they chopped off the tail, saying it's highly unlikely. So they never took any, when that occurred, they would be wiped out. Now, they were bailed out. The next was, of course, the Greenspan put, when after the dot-com bubble, he, in fact, put a floor and losses people would make. Now, they promoted excessive risk-taking. The third was the promotion of affordable housing for the poor by Clinton. And they did this to these unreformed twins, the Freddie twins, and that led to the development of subprime mortgages. Fourth, the Basel II capital adequacy requirements, now because they then constrained, what banks could count as part of their capital, that led to the banks avoiding this form of regulation they always do, through putting their risky assets into off-balance sheet vehicles. These are the SIVs, which has led to the opacity which is currently being bemoaned in huge numbers of instruments. I mean, all sorts of letters of the alphabet you can use. Fifth, when the housing bubble burst and the credit crunch began, the Fed then chose to bail out Bear Stearns. Now, this sent a signal that the Fed, and Bear Stearns was not a deposit-taking institution, that Bear Stearns, bailing it out, sent the signal that the Fed's balance sheet was now open to non-deposit-taking banks. Okay? Of course, this had been earlier signaled by the LTCM, this bailout, this just confirmed it. Sixth, and most heinously of all, that had gone before, the US authorities then chose not to bail out Lehman's. This is rather like a fallen woman suddenly finding virtue. Now, this dashing of the bailout expectations that the authorities had endorsed only in the spring led to the intensification of the credit crunch. Seventh, as the authorities finally seemed to tackle the toxic subprime-infected financial assets, which had caused the crisis, through TARP, which is supposed to buy up these toxic assets, the market seemed to have calmed somewhat. And then Bolson decided that he's going to change the purpose of TARP from buying these toxic assets to recapitalize the banks, leaving the toxic assets they were. And as soon as markets realized, they went into a free fall. So the essential step of forcing banks to come clean on their balance sheets and then removing the toxic assets they revealed into a newly created cordon sanitaire. Many countries, Sweden and many other third world countries, this is a standard IMF prescription for someone suffering a financial crisis. And this has still not been taken.